fellow investors. Welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Dr. Pranay Parikh, and he is not only a doctor, serial entrepreneur. He's created an online course. He's a podcast host. He's doing all these different things. Oh, by the way, he's purchased over 1.1 billion in real estate and really lives out his mission to help physicians invest in real estate and more specifically launch 10,000 physician-led businesses. So Pranay, thank you for being here today. Really excited to hear your story and what you've got to share with us.
Yeah, thank you for the opportunity.
So let's start at the top. Tell us, you've got an interesting journey from medical professional into real estate, and then it sounds like a few other maybe divergence in the path. So tell us a little bit more about who you are and yeah, how you got to where you are today.
Yeah, so in my podcast, I talk about a very unconventional way into medicine, right? So a lot of people have kind of straight and narrow, right? They go straight into medicine. That's what they've always wanted to do. That's true for me too. I've always wanted to be in medicine, but I've also had a ton of other interests, right? I tell people, they want you to be well-rounded until you get to medical school, and then they want you to only focus on that, right? I got into medical school, but I was still interested in other stuff. For example, I used to do art shows, charity art shows for Doctors Without Borders because I wanted to keep giving back, right? And I wasn't able to afford anything because medical school was expensive. I wanted to do research, but I wanted to do research in everything. I didn't want to just pick a specific specialty to do research in, right? So finally, after I had graduated, did residency, medical school, I wasn't able to do that much because it was so difficult. After I finished, I realized that, the only way I was making money, and it was decent money, but I had a lot of loans, was I would work an hour and I'd get an hour of pay, right? So I wasn't working at all. I wasn't getting any money. And, I wanted to make sure that my life, or at least my expenses, were taken care of without having to work, right? And in the starting, I invested in the stock market just like everyone else, but I wanted something that where I can have control, right? So, and that's where I came to real estate. My parents had bought properties, and as real estate has created more millionaires than anything else. So, 14 months or so out of residency, when I was an attending physician, I bought my first property, and it was great. It was in LA. I found a great property. Almost got 100,000 in equity right away because I bought well. I was like, okay, I'm gonna do one of these a year, and then the next year I spent probably like 200 hours trying to find a property, and I just couldn't find one. And I realized that, now I was spending my time on something and I was getting zero back. I should have just spent it at work. That's where I came to passive real estate, right? And passive real estate, at least at the time, this was many years ago, there wasn't a great education source for it. Everything was kind of biased, and now I'm biased as well because now I have an equity company, but at the time I didn't, right? And there weren't any books. Now there's a couple books we can talk about. But I wanted to teach people how to how to find deals, vet them, and what to do following up. So we created a course, and we thought we were done. We taught thousands of doctors how to invest in real estate, and we're like, okay, we taught you how to fish, go fish, right?
Yeah.
But a lot of people came up to us. They're like, yeah, now we understand, but we still want you to do it, or a lot of them got into bad deals and we're like, hey, this isn't that good of a deal. I thought we taught you guys something else. They're like, yeah, we don't really have the time to do this because we're working full medical practices. So we started Ascent Equity Group, where it's almost like concierge bespoke experience, where we take care of everything. We find the deals, we negotiate, and we do joint ventures, and we can talk about that later, but we really control the whole process and make sure that doctors, dentists, and really anyone that wants to invest with us, it's just those are the people we focus on, are getting the best deal possible.
Gotcha. And what kind of properties are you guys acquiring?
Yeah. So we do bread and butter of commercial real estate. So we focus on multifamily, so apartment complexes, because no matter what happens in the economy, people need a place to live, and we focus on kind of value add class B, which is often called the Goldilocks class.
Hmm. Gotcha. And what markets are you focusing on?
Yeah, so as I mentioned to you, I live in California. I'm used to paying state taxes, but our investors do not like that. So we focus on low tax places, no tax. So we've done Florida, Texas, Arizona. We were looking at the Carolinas. So we really focus on trying to minimize that tax burden.
Gotcha. So kind of sun belt states, then out west in Arizona.
Yeah.
Oh, very cool. And how have you so you started, with this idea that you need to invest in real estate. You kind of experience the same thing all of us real estate or all of us have at one point that are now in multifamily. I feel like is like the single family is not really scalable, right? It's difficult. You realize how hard it is. Like you got pretty lucky on that first one, and on that second one, you realize how hard it is to actually find good deals and to do that at scale, right? And so you realize by going into multifamily, you could get one deal with a bunch of doors instead of one deal with one door, right? And kind of evolved in that. And then through the training, it sounds like you found a network of people who, as they go through the training, maybe they realize how difficult this is, or they try it themselves, or they realize that their highest and best use is not to buy themselves another job, which is, managing an apartment complex or something else, right? And so you've provided this opportunity for folks to come and invest. So tell me more about about the company. Tell me more about the company, how you've built it. Who are your partners, or what does the sponsorship team look like?
Yeah, and Kent, my first property was a multifamily. It was a 4 unit, but
Oh, nice.
yeah, so I'd done a ton of reading, and everyone was like, buy 4 units, because more than five is commercial, so you can get a residential loan. And I did
Mhm.
everything right, but it was just a ton of work, and it still is, right?
Yeah.
And I have a property manager. They take care of everything. Honestly, I probably get a couple phone calls a month, right? Barely any. It's really high level decisions, but it's cognitive bandwidth, right? I know you probably have you get that check, once a month, and you're like, okay, you're just praying that nothing went wrong, right? No one left the unit, that nothing had to be fixed, right? And it just is cognitive bandwidth and stress, right?
Mhm.
When someone
Mhm.
else is handling it, it's nice, right? Even if I'm willing to pay a fee, because the thought was, okay, now I have 4 units. Think about 40. Like that's gonna just be, and you really need to have probably around 30 to 50 to really start making a dent on your
Mhm.
income, right?
Mhm.
Um, Obviously, we're not taking into account equity and all that stuff. I'm just talking about cash flow.
Yeah.
And that's 40 doors where one thing can go wrong, right? And so, yeah, it's a big issue. So, yeah, Set Equity Group. So, we have the principals are three doctors, myself, Mith Jagrapagasian. He's a hospitalist doctor like me. Um, and Peter Kim, who created the brand called Passive Income MD. He's been doing this for many years
Yeah.
and investing as an LP, and we created this as a GP.
Oh, fantastic. And are you guys still practicing doctors, or is everybody fully focused on building out the real estate business now?
Yeah, so the $1.1 billion of real estate. I did that while practicing full time. I still like practicing. My partners, they work a couple shifts a month. They do mostly the set free time.
Yeah.
I've had to cut down to like 0.8. I'll probably do down to like 0.5 full time soon. But I'm stopping by kicking and screaming.
Yeah, yeah, you love it. Obviously, it's your passion. So, I where I want to go and kind of understand better is, I mean, 1.1 billion is a lot of real estate, and you guys are three partners.
Mhm.
Sounds like pretty focused, but not necessarily full time. What is the rest of the team like? How did you go about building out the rest of the team to allow you to buy so much real estate and maintain that portfolio?
Yeah. So, the w- our business model has kind of evolved over time. right? So
Sure.
initially we would do like a fund of funds model, and that kind of inflates the number of real estate and number of units you have, right? Because you're almost like an LP, but we're an LP uh, for a couple million in each deal, so we can kind of
Hmm.
throw our weight around.
Hmm.
But starting about the latter half of the year, we started doing what is called joint ventures, right?
Hmm.
Where we are 95 to 97.5% of the equity. So we almost act like an institution.
Yeah.
And that carries a lot of power, including major decision rights and basically anything we want on the property. We're
Yeah.
able
The
to,
ability to negotiate terms because so
yeah,
you guys are coming in as the equity partner
yeah,
in these deals and partnering with operators who are
exactly,
asset managing the properties. I got you. Now I understand. Now I
exactly.
understand the business model.
Yeah, and
That
so that's often called like an allocator model, and
mhm.
that's probably why we're able to scale so much.
Absolutely. Absolutely. So you guys are really about creating a network of like-minded investors to come together to be able to pool funds, to be able to then come into a deal with an operator. And because of your size, um, attempt to negotiate preferred terms, right?
Exactly,
Yeah.
exactly. And we built out our team, so we have probably one of the best asset managers in the game that has been told to us by multiple sponsors. And so uh, we have our own investor relations and
Yeah.
project management. So we built out a team that now we're able to kind of not just because what happens a lot, Kent, with allocators is they get into a deal and they're like, okay, time for a next deal, right? Because they make
Mhm.
most of their money on the front end. But for us, we really have an alignment of interest. So we get paid on the back end with the promote. And that's important because you want whoever you're investing with to be with you in the whole deal. So,
Mhm.
for example, and we do this because we're joint ventures, we do weekly calls with property management. And some of the sponsors had to set up a system to do that because they were like, yeah, we don't talk to we're the operator, we don't talk to them every week. We're like, I don't care. Like we want weekly phone calls with the operator. We do
Mhm.
at least quarterly site visits. Some of our properties we go every month or every 2 weeks in the
Yeah.
beginning when they're kind of doing the business plan. So we're
Sure.
very hands-on. We're,
Yeah.
you know, we're almost like a Goldman Sachs or like a Blackstone. We really want to make sure that this is successful for our investors.
Gotcha. So yeah, you guys are providing that extra level of I guess diligence and oversight,
Mhm,
within the property too.
mhm.
And yeah, if sponsors aren't meeting with their property manager weekly, they definitely should be.
Yeah,
We, we
yeah,
we
yeah,
we meet weekly on all of our properties, and it does
yeah,
become difficult as you begin to scale. But you just have to build out a team to allow that type of um, that process to maintain. Because I think without that accountability, you really don't know what you're getting, and I think that to me that gives me panic. We got to know what's going on. So the weekly meetings I think are a great idea for you guys to stay on top of property management. So yeah, so the business is developed. You're partnering with these different groups. A lot of the listeners to this show are similar to you guys, kind of these. I mean, you're more passive or you're more active than most passive investors, but you're not um, buying and running the deals, right? So I think a lot of what you have to say will resonate with the audience. What is it that you're looking for when you look to partner with sponsors? I mean, what is there like a framework you go through, a list of criteria? Kind of walk us through how you pick the sponsors to work with.
yeah. And you got the key question, right? Because if you're giving the keys to someone, right, you technically are if you're giving them equity, then who they are is probably one of the most important things in the deal, right? If you put LeBron on a team, it's going to get to the playoffs, right? Doesn't matter what the team is, right? They might not win, but they're getting to the playoffs, right? Same with Kobe. So we look at, and that's the thing, it's hard to, there's no, and we've tried to do this, we've tried to create an objective kind of equation to
Yeah.
figure this out, but it you can't, right? It's the art.
Right.
So what we do, and it's evolved over time, as we've grown and matured in the business as well. So what we do is, of course, we start with track record, right? How successful have they been? For example, if you've done anything in the last 5 years, you probably have like a 30 to 40% IRR, right? Net. And that's anyone, right? I mean, you have to be really bad to not get that. Or just a different business model, which is fine.
Yeah. Yeah.
But so we look at people, we like to have at least 10 years of experience, been through, multiple cycles. We like to have at least 500 million assets under management, right? And that's just a screening, right? And then we talk to them. And now that we have our own in-house asset management, we look through all their numbers, right? Show us your properties, show us how they're performing, right? And in a lot of these markets, like Orlando and Texas, we have our own vendor network that we've developed over time. So we do basically everything else other than operating. So
Yeah.
because of that, we're able to really double check, right, the assumptions, because a lot of people, and if this is the business model, that's fine. A lot of people have just bought stuff and sat on it, right? And then a couple of years later, they sell it, right, with 10% renovated, which is okay, right? That's okay, but I think starting now, that's probably not going to be okay, right? With the inflation and all this stuff, I think you're going to really have to show a change in the NOI. You can't just kind of hope for cap rate compression. So that's the screening. We talk to them, right? Ideally, we visit them. Fortunately, a lot of real estate people are in LA. A lot of the sponsors we've noticed live in LA, so I go have lunch with them. There's just something about seeing someone eye to eye that beats anything you can talk about. But at the end of the day, it's how they performed, right? It's a track record, reputation, and looking at their current deals.
Gotcha. So I'm curious your asset management process. I know you said you're having weekly meetings with the property management. What are the things that you guys are looking at, daily, weekly, monthly, to make sure that these projects are going as expected?
Yeah. So big thing is occupancy, right? And you can't really take that in isolation. So occupancy, number of units renovated, right? Rent increases, concessions. Basically, you want to look at the pro forma and see how we're going towards that. And the pro forma, it's yearly, right? So how do we break that down? So if we want to get an average of $200 increase for these one bedrooms, right? How many units will have to be renovated at the time, right? And we have pretty conservative assumptions. Fortunately, all of our units have had natural organic growth. We bought something a couple months ago. It has 14% rent growth, but we don't want to count, right? Because who knows, maybe rents will decrease this year, depending on everything that's going. So I think you have to really dial in and look at a lot of these numbers. And you don't want to look at too much, because then you'll get a false sense of security. But occupancy, number of units renovated, and rent increases, those are probably the top three.
Gotcha. Okay. Well, great metrics to share. And do you guys have, as you're reporting out to investors, I mean, what does that process look like? How are you guys communicating with the investors? What are you sharing? And how do you keep them in the loop on what's happening?
Yeah, so we really like video. And so what we do is we do quarterly video updates, and people are able to send us questions. We also do, depending on the property, some properties, they send us monthly distributions, so we send monthly reports. But most of them are quarterly. So we'll send them quick quarterly video, hey, here's what's going on the property. Here's what we're working on. And I find people go love it. Very few people go to it live, but a ton of people watch it the replay.
Sure. Sure. No, I think video is such an engaging format, and nowadays it's so easy to put a video together versus even write an email. And so, I mean, I think that's a great way to engage with investors. As you're, so you said most of your investors are doctors, dentists, maybe medical professionals. We
Mhm.
define them in that way. Why do you think that group of people just gravitates toward real estate? Why are there so many? And like what is the importance for the medical professionals in the world to be investing in real estate?
Yeah, so a couple of things, right? A lot of doctors are worried about tax implications, right? And making an investment that increases your taxes when you're probably in the top tax bracket doesn't make a ton of sense for us, right? So, as you know, distributions, the money that you get monthly or quarterly from passive real estate, is tax deferred, right? So you get depreciation, so you're getting, a couple years worth of, it's almost a loan, right? A loan from the government, tax free. And then there's ways of deferring that even further. So some of our deals, we are 1031 eligible. So that means we can even defer it longer and defer it longer and defer it longer, right? So taxes are a big thing, and probably us doctors think a little bit too much about taxes in general, but taxes, I think having something stable, right? Especially now with all the volatility, right? The stock
Mhm.
market, I was in the stock market, I was buying the dip, and then I bought the dip again, and then I ran out of money because it kept dipping, you know?
It keeps dipping. It's dipping again.
Yeah, yeah. Okay, I was like, okay, I shouldn't have bought the first couple of dips, right? And then crypto, I mean, my portfolio is down like 2%, right?
Yep.
And so people like stability. They understand real estate, right? People need a place to live. And I mentioned Class B, which is Goldilocks, right? When the recession comes, people move down from Class A to Class B. People also, especially now with the interest rates, people were planning on buying a house and are priced out, so they'll go back to apartments, right?
Mhm.
But
Mhm.
also when the economy is doing well, people go from Class C and they're able to upgrade, which is nice, right? So you
Yeah.
kind of have a nice cushion and buffer each way. Economy's doing well, economy's doing poorly. I
Yeah,
think. Go ahead.
oh, I was gonna say I agree with you there. I mean, that's really mirrors our strategy, which is B and C space, kind of very middle of the road workforce housing, value add deals, a lot of safety in those type of deals. Because we're buying things that are, I look at it as we're buying businesses that have been cash flowing for 30 or 40 years. And what would have to happen for that business to go away, right? You'd have to have a complete drop in demand, which isn't going to happen. We're moving the other way, right? You'd have to have some serious break in operations, which isn't going to happen because all these properties we're buying, we're we know that we can come in and manage them better. So you think about the stability there. Um, that's really core to our philosophy as well. So it sounds like we're aligned.
Yeah, yeah, for sure. And a lot of these doctors will say the same thing about active real estate, right? And they'll buy a couple and
Hmm.
realize it's a 30-year marriage, right?
Yeah.
And they'll come to us and they'll be like, yeah, I don't know what I was thinking. We're like, yeah, it's exciting to do active real estate. I'll be honest, it
Yeah.
was fun buying my first property.
Yeah.
And I and then you get kind of sick of it that the shininess goes away and you're like, oh,
Yeah, you get into the day to day and you realize
yeah,
the
uh,
tenants and toilets and termites, they're not so much fun.
yeah,
The
yeah.
I mean, similarly, I speak with a lot of doctors, in kind of a similar thing where maybe they want to go buy, a duplex or they want to get into that. And oftentimes I try to bring, and it's not just for physicians, but people that entrepreneurs, others that are being highly successful in some field. I'm typically trying to bring them back to look, we all have one highest and best use, and we need to focus on what that is. And if you already have a successful business, focus on continuing to make that business successful, right? Focus on pursuing that passion. Don't buy yourself another full-time job, which is what you're doing when you're buying a duplex or a fourplex or something, at that scale. You are buying yourself a job at the end of the day.
Yeah, yeah. And you mentioned my podcast earlier, and it's called From MD to Entrepreneur. And I've helped hundreds of doctors launch businesses.
Hmm.
And that's fun. Like, very few people go into real estate saying, I'm starting a real estate business. But that's what
Yeah.
you want, right? That's what you're doing. That's what, I joke that I found an active way to do passive real estate, right?
Yep.
It's a lot of work. I'm sure you do a lot of work, right? But most people don't want to do a real estate business. That doesn't excite them. Instead, maybe a coaching business, a writing business, starting your own patent, product business. Like,
Hmm.
the world would be a much better place with a lot more doctor-led businesses right now. But very few people say, okay, yeah, I'm gonna own 100 units and I'm gonna manage this real estate business. Most doctors aren't like that.
Yeah. Yeah. That makes a lot of sense. So if you have, in the conversations that you're having, what's the general sentiment of investors? I mean, there's a lot of uncertainty out there, right? There's a lot of negative news. I mean, where are people at, and what is your message to folks as you're talking with, maybe your investors or people that are interested in investing?
Yeah, I think a common misconception that people are having is that you are going against the stock market or crypto or all this stuff. But you're what the choice people are making is sitting on their butts, right? Not investing, sitting on the sidelines, not investing.
Hmm.
So you got to convince someone that you're actually losing buying power right now at 9%, right? Because of inflation.
Significant. Yep.
Yeah, yeah, and it's only going up, right? And so, how do you increase cash flow, but something that's stable, right? And I tell people, um, if I can make you a 5% return, which we quadruple that, but if I can make you a 5% return in this market when the stock market is down 30%, that's huge, right?
Yeah.
Anything positive right now would be amazing. So that and I don't know what kind of debt you guys have been doing, but we've been doing fixed long-term debt. We've been lucky. We just got a deal that we closed 2.9% fixed at 9 years and 4 years of interest only. So
Were
if you
you
can get a
assuming
loan,
the loan?
we are assuming the loan.
Assuming the loan. I'd say that's
Exactly.
the only way you're going to get debt like that these days.
Right. Yeah. And
That's a
I
good
tell people,
deal.
I'm like, yeah, I mean, that loan is so good because it was created 4 years ago, right? It's
Right.
literally a 4-year-old loan. And so things like that, and assuming a loan is not easy. You're working with the
It's
government and
not easy.
get approved and paperwork takes forever. But if you're able to get something like that, and I tell people, like your company, right now to do deals, you got to find something special, right? Like a unicorn. Otherwise, we're just sitting on the sidelines as well.
Yeah, I gotcha. Yeah, I think that in general, I would not recommend fixed rate debt right now, unless you're assuming a loan at a 2.9% interest rate. That's a little bit different. If you're going to go into new fixed rate debt right now, you're going to be 5.5, 6 north. And I think you're actually going to be locking in as we head up toward a peak over the next, maybe 12 months. So I think that's a great find. All those long-term fixed loans, are going to have tremendous value over the next 24 months. And so those are great. Those assumptions, while a pain in the butt, I mean, we went through one last year. It took 6 months to get through the assumption. You can get similarly great deals, uh, you know, and so I agree with you that there has to be something special. I mean, I think the thing people really need to look out for is what's that debt service coverage look like, and what is just the debt environment in general. If you can lock in at a low fixed rate, you take that interest rate risk off the table, which is a significant risk, I think, over the next, let's say, 24 months as things start to shake out. So Yeah, I think that's a great opportunity to bring to your investors. That sounds like there's a lot to appeal just in that deal from a debt standpoint. But I think people need to be paying more attention to debt. I think people don't pay enough attention to debt. I think there's a lot of focus on equity upside.
Mhm.
There's not enough focus on potential downside. And when you think about debt being anywhere from, maybe 70 to 80% of the capital stack, that's the largest investor in the deal. Um, and that sits above all of the equity investors, right? If you can't pay the loan, you can't pay the equity. And so I think a focus there in general is really important for folks over the next, let's say, 24 months. So yeah, I think it's a way, if you can find an assumption like that, you can find a really interesting way to add value for folks.
Yeah, this is actually our second assumption of the year. The first assumption had a humongous prepayment penalty, so we got
Hmm.
a $4 million discount on the property,
Hmm.
and the prepayment penalty goes up if interest rates go up 1%. And we bought this in February, so
Hmm.
we have a huge $4 million buffer because interest rates have gone up so much.
Yeah, yeah, that's great. That's fantastic. Well, awesome. Well, Pranay, thank you so much for coming on the show and sharing your story with us. I think really interesting. I think helping people understand the opportunities that are out there and facilitating those investments for folks like yourself in the medical community. Before I let you go, I want to take you through our keys to success round. There's 4 questions I want to ask you. The first one is, if you were to invest in someone else's deal, and you can only ask them one question, what would that one question be?
Yeah, I would say track record. That's the first thing we ask people, and that screens out 98% of people. And sometimes you don't get a full track record, and that
Mhm.
tells a lot as well, right? And kind of how quickly they get it back to you. And so just that process of getting their track record and asking them for it will tell you a lot.
Yeah, absolutely. I mean, it's you can't, the data is what the data is. It shows how successful you've been, right? And therefore you're expecting them to be successful in the future. So I think track record is a great place to start. What are you most proud of in your career?
Yeah, we've been able to help so many doctors and really change lives by making the whole investing process more understandable. When I graduated medical school, I didn't know anything about finance or investing. And we focus on real estate. We really talk to people about the whole investing career, right? And I say no to people all the time. People are like, "Oh yeah, I want to buy a house in 2 years. You think this will exit?" I'm like, "Yeah, no." They're like, "3 years? No, you should probably have much longer to
Yeah.
win with this money, right?"
Yeah.
And I think just being able to provide that comfort, and because we taught that course, people know that we really come from a avenue of education, really trying to educate our people. And our investors ask us some really hard questions because they've been through our course, and we love it. It makes us sharper.
Yeah, absolutely. What's a book that everybody should read?
Yeah, so I was thinking about this, and I get this passive real estate question a lot. And so the book I've been recommending is The Hands-Off Investor by Brian Burke.
Hmm.
And it's really great basics for learning how to do it. And a lot of people are able to get into their own deals, or they otherwise they come to a shop like ours where we kind of do everything for them. I think there's plenty of room in the market for everyone.
Yeah, absolutely. And that's a great book. It's a good recommendation. What is your number one key to success?
Yeah, I think he's trying. I got my start in real estate by my partner taking a chance on me. He's like, he has this brand called Passive Income MD, and he's like, I have a Facebook group that I haven't done much with. You want to help grow it? And I knew nothing about Facebook groups. I didn't know anything. I was like, yeah, every day I'll post something. I'll try to be interesting. Help it grow. I had helped it 3x, right?
Yeah.
But just by showing up, right? And I think showing up is really 80 to 90% of my success.
That's awesome, man. Consistency. I mean, I think that's a general theme throughout the show is consistency and showing up. You do that long enough. I agree with you. That is a huge factor in success. Well, thank you, Pranav. Thank you so much for coming on the show today. If folks want to learn more about how to invest with you guys, learn more about your training courses, where should they reach you?
Yeah, so my email is pranay@ascentequitygroup.com. Our website, ascentequitygroup.com. You'll see a picture of my nice family right in the middle and the rest of us. And then I have a podcast, teach doctors and other people to become entrepreneurs, and that's From MD to Entrepreneur podcast.
Awesome. We'll make sure all those are listed below. Thank you so much for coming on the show today. And Pranay, I hope you have a great rest of the day.
Thank you, Ken.